Welcome to Module 3, where we stop talking about theory and start making things happen. If Module 1 was like studying for your driver's test and Module 2 was learning about different types of cars, then Module 3 is where we actually get behind the wheel and start driving. Getting pre-approved is your golden ticket to be taken seriously by sellers and real estate agents. It's the difference between being a window shopper and being someone who can actually buy a house. Without pre-approval, you're basically that person at the luxury car dealership who just wants to look around. Nobody's going to spend any time with you. By the end of this module, you'll know exactly how to find the right lender, what documents to gather for your pre-approval, and how to avoid the financial landmines that can blow up your mortgage approval. Plus, we're going to talk about the mysterious 60-day look-back period, which sounds like something from a spy movie, but is actually much more boring and way more important to your home purchase. So let's turn you from a potential buyer into a pre-approved buyer who can make offers with confidence. Time to get the show on the road. Finding the right mortgage lender. All right, let's talk about finding a mortgage lender, which is kind of like dating, except instead of looking for someone who shares your interests and values, you're looking for someone who will lend you hundreds of thousands of dollars at the lowest possible interest rate. Much more romantic, really. You've got three main types of lenders to choose from: banks, credit unions, and mortgage brokers. Each has their pros and cons, kind of like choosing between different types of pizza. They're all pizza, but the experience can be very different. Let's start with banks. These are the traditional lender. Think Wells Fargo, Bank of America, Chase. Banks are like the McDonald's of mortgages. You know what you're getting, they're everywhere, and they have standardized processes. The advantage is they're usually well-funded and can close loans quickly. They often have competitive rates, especially if you already have accounts with them. The downside is you're dealing with a big institution where you might feel like just another number. Customer service can be hit or miss, and they might not be as flexible with unique situations. If your income is complicated or if you're self-employed, big banks might not be your best friend. Credit unions are the smaller, more personal option. They're member-owned, which means they're not trying to maximize profits for shareholders. They're trying to provide good service to their members. Credit unions often have slightly lower rates and fees, plus more personalized service. The catch with credit unions is you have to be eligible for membership, which usually means living in a certain area or working for a certain employer or being related to a member. They also might have limited branch locations or technology that feels like it's from 2003. Then you have mortgage brokers, who are like the matchmakers of the mortgage world. Brokers don't lend money themselves. Instead, they work with multiple lenders to find you the best loan. Think of them as personal shoppers for mortgages. The advantage of brokers is that they can shop around for you and might have access to loan programs you wouldn't find on your own. They're especially helpful if you have unique circumstances or if you don't want to spend your weekends calling different lenders. The potential downside for brokers is getting paid by commissions. So you want to make sure they're looking out for your best interests, not just pushing you towards the loan that pays them the most. Good brokers are worth their weight in gold, but like any profession, there are some who are more interested in their commission than your best deal. So how do you choose? Here are the questions you should ask potential lenders, and I recommend talking to at least 3 before making a decision. It's like getting multiple quotes for home repairs. You want to make sure you're getting a fair deal. First, ask about interest rates, but don't stop there. Ask about the annual percentage rate, or APR, which includes the interest rate plus all the fees rolled into one number. It's like comparing the total cost of a car, including all the add-ons, not just the base price. Ask about closing costs and origination fees. Some lenders advertise low rates but make up for it with high fees. Others have higher rates but lower fees. You want to compare the total cost over the life of the loan, not just the monthly payment. Ask about discount points. These are fees you can pay upfront to lower your interest rate. Each point typically costs 1% of your loan amount and lowers your rate by about 0.25%. Whether points make sense depends on how long you plan to stay in the house. Ask about lock periods. Interest rates change daily, sometimes multiple times per day. A rate lock guarantees your rate for a certain period, usually 30 to 60 days. Make sure your lock period is long enough to close your loan, because if rates go up and your lock expires, you're stuck with a higher rate. Ask about their timeline. How long does it typically take them to close a loan? In a competitive market, a lender who can close in 3 weeks might help you win an offer over someone who needs 6 weeks. Ask about their loan approval process. Do they underwrite loans in-house or send them to another company? In-house underwriting is usually faster and gives you more control over the process. Ask for references from recent borrowers, especially if you have a unique situation. A lender might claim that they work with self-employed borrowers, but if you want to talk to someone who actually went through the process. Here's how to compare loan estimates effectively. Because this is where the rubber meets the road. The law requires lenders to give you a standardized loan estimate within 3 business days of your application. This form makes it easier to compare apples to apples. Focus on 3 main sections: loan terms, projected payments, and costs at closing. The loan terms section shows your interest rate, monthly payment, and total amount you'll pay over the life of the loan. This is where you can see the big picture cost. The projected payments section shows what your monthly payment will be, including principal, interest, mortgage insurance, and estimated taxes and insurance. Remember, this is an estimate. Your actual payment might be different based on your specific tax and insurance costs. The costs at closing section breaks down all the fees you'll pay. Some of these are lender fees that you can negotiate or shop around for. Others, like appraisal fees and title insurance, are pretty standard regardless of which lender you choose. Pay special attention to the in 5 years section at the bottom of the form. This shows how much you'll have paid in total and how much you'll still owe after 5 years. This is helpful for comparing loan options. Now, let's talk about red flags to avoid, because unfortunately, not all lenders are looking out for your best interests. If a lender pressures you to sign documents before you've had time to review them, that's a red flag. Buying a house is probably the biggest financial decision of your life, and you should have time to read and understand what you're signing. If a lender promises you a rate that seems too good to be true compared to everyone else, it probably is. They might be planning to hit you with fees later or switch you to a different loan program at the last minute. If a lender can't clearly explain their fees or gives you vague answers about closing costs, find someone else. You want a lender who's upfront about all costs from the beginning. If a lender encourages you to lie on your application or suggests ways to massage your income or assets, run away. Mortgage fraud is a federal crime and you don't want to be associated with anyone who suggests it. If a lender asks for upfront fees before doing any work, be very careful. While some legitimate fees like application fees or appraisal fees might be required upfront, large fees should generally be paid at closing. The bottom line is you want a lender who's professional, responsive, and transparent about the process and costs. You're going to be working with this person for the next month or two during the most stressful times of your life, so make sure you feel comfortable with them. Remember, the cheapest rate isn't always the best deal if it comes with terrible service or hidden fees. You want the best combination of rate, fees, service, and reliability. It's like choosing a surgeon. You want someone who's both skilled and affordable, but skill probably matters more than saving a few bucks. The pre-approval process. Now let's dive into the pre-approval process, which is basically like a financial background check combined with a really intrusive job interview. The lender is going to want to know everything about your money, where it comes from, where it goes, and whether you can be trusted with their money for the next 30 years. First, let's talk about the documents you'll need to gather. I recommend creating a folder, physical or digital, and collecting all of these before you start the process. It's like preparing for a really boring scavenger hunt where the prize is a mortgage. You'll need pay stubs from the last 30 days showing your year-to-date earnings. If you're paid weekly, that's probably 4 pay stubs. If you're paid monthly, it might just be 1. Make sure these are the official pay stubs from your employer, not handwritten notes that say, hey, Johnny's a good worker and makes $50,000. You need your tax returns from the last 2 years, including all schedules and forms. If you file jointly with a spouse, you'll need their information too, even if they're not going to be on the mortgage. The lender wants to see your complete financial picture. You'll need W-2 forms from the last 2 years. If you've changed jobs recently, you'll need W-2s from all employers during this period. If you're missing any W-2s, you can request copies from your employer or get transcripts from the IRS, though that takes longer. If you're self-employed, you'll need additional documentation like profit and loss statements, business tax returns, and possibly a letter from your accountant. Self-employed borrowers basically need to prove they're actually making money, not just playing business. You'll need bank statements from the last 2 months for all accounts: checking, savings, investment accounts, retirement accounts. These need to be complete statements showing all transactions, not just summary pages. The lender wants to see where your money comes from and how you manage it. If you're getting gift funds for your down payment, you need a gift letter from the giver and documentation showing where their money came from. The lender wants to make sure this is actually a gift and not a loan in disguise. You'll need documentation for any other income sources: alimony, child support, rental income, investment income. If it's money you're counting on to qualify for the mortgage, the lender needs to see proof that it's reliable and likely to continue. If you have outstanding debt, you'll need statements for these too: credit cards, car loans, student loans, other mortgages. The lender needs to see your complete debt picture to calculate your debt-to-income ratios. Here's a pro tip: organize these documents clearly and make copies of everything. Some lenders will want original documents, others will accept copies or electronic versions. Being organized makes the process smoother and makes you look like someone who has their life together. Now let's talk about how long pre-approval takes. In a perfect world, with a simple financial situation and responsive lender, you might get pre-approved in a few days. In the real world, plan on 1 to 2 weeks from the time you submit your completed application. The timeline can vary based on several factors. If you're self-employed, have multiple income sources, or have unusual circumstances, it might take longer. If you're missing documents or the lender needs clarification on something, that adds time. During busy periods like spring home buying season, lenders might be backed up and take longer to process applications. This is another reason to start the pre-approval process early before you start seriously house hunting. Once you're pre-approved, you'll get a pre-approval letter, which is like a VIP pass for house hunting. This letter states that you're approved for a loan up to a certain amount, subject to finding an acceptable property and final underwriting. Your pre-approval letter should include the loan amount you're approved for, the type of loan, and the terms. It should be addressed to you, not to whom it may concern, and it should be on the lender's letterhead with contact information. Some pre-approval letters include conditions like subject to satisfactory appraisal or subject to verification of employment. These are normal, but make sure you understand what conditions apply to your approval. Here's what your pre-approval letter means. It means the lender has reviewed your finances and believes you can qualify for a loan, assuming nothing major changes. It's not a guarantee. You still need to go through final underwriting after you're under contract on a house. But pre-approval is much stronger than pre-qualification, which is basically the lender's guess at what you might qualify for based on limited information. Pre-qualification is like someone saying you're probably smart enough for college. Pre-approval is like getting an acceptance letter. Now here's the critical part: maintaining your financial status during the process. Getting pre-approved is not the finish line, it's more like the starting line. You need to keep your finances stable from pre-approval through closing, which could be several months. Don't make any major purchases during this time. I know it's tempting to buy furniture for your new house, but wait until after closing. The new car that you've been wanting, it can wait. Even smaller purchases can affect your debt-to-income ratio and potentially derail your approval. Don't open new credit accounts. This includes credit cards, store cards, or any other new credit. Each credit inquiry can lower your credit score, and new accounts change your credit profile. Don't close existing credit accounts either. This can actually hurt your credit score by reducing your available credit and potentially shortening your credit history. Don't make large deposits into your bank accounts without documenting where the money came from. Lenders will scrutinize any large or unusual deposits during the look-back period. Don't change jobs unless absolutely necessary. If you do need to change jobs, notify your lender immediately. A job change doesn't automatically disqualify you, but it needs to be documented and might delay your closing. Don't co-sign for anyone else's loans. This adds to your debt obligations and changes your financial picture. Basically, from the time you get pre-approved until you close on your home, pretend your lender is watching your every financial move, because they basically are. It's like being on financial probation, but the reward is home ownership. The key is communication. If anything changes in your financial situation, tell your lender about it immediately. It's much better to address issues early than have surprises pop up right before closing. Asset verification and look-back periods. Now we're going to talk about something that strikes fear into the hearts of homebuyers everywhere: the 60-day look-back period. This sounds like something from a spy thriller, but it's actually just the period where your lender examines your bank statements with the intensity of a forensic accountant looking for evidence of financial crimes. The look-back period is typically 60 days, though some lenders go back 90 days or more. During this period, the lender will review every transaction in your bank accounts to verify that your down payment funds are legitimate and to make sure you haven't been doing anything that might affect your ability to repay the loan. Think of it as like having a really nosy accountant aunt who wants to know about every single purchase you've made in the last 2 months. She's going to ask about that large deposit, wonder why you spent so much at Target last Tuesday, and definitely want an explanation for that weird payment to your cousin Steve. The lender is looking for several things during this review. First, they want to verify that your down payment funds have been in your accounts long enough to be considered seasoned. This proves that the money is yours and not borrowed from somewhere else. They're looking for that source of any large deposits. Generally, any deposit that's more than 50% of your monthly income is considered large and needs to be documented. So if you make $5,000 a month and you deposit over $2,500 is going to raise some questions. They're looking for patterns that might indicate undisclosed debt or income. If you're getting regular deposits from an unknown source, they'll want to know what those are. If you're making regular payments to someone that aren't on your credit report, they'll want to understand that too. They're also looking for any suspicious activity that might indicate fraud or money laundering. Large cash deposits, frequent transfers between accounts, or transactions that don't match your stated income and employment will get their attention. So how do you document your down payment funds properly? The key is to create a clear paper trail that shows where every dollar came from. If your down payment is coming from savings you've accumulated over time, that's the easiest situation. Your bank statements will show regular deposits from your paycheck and a gradual buildup of savings. This is like having a clean driving record, no explanation needed. If your down payment includes funds from the sale of assets, you'll need documentation of that sale. Sold some stocks? You'll need statements showing that the sale and transfer of funds to your bank account actually happened. Sold a car? You'll need to show the bill of sale and proof that the funds were deposited. If you're getting gift funds, you'll need a gift letter stating that the money is a gift with no expectation of repayment, plus documentation showing where the gift giver got the money. The lender wants to make sure your parents aren't secretly borrowing money to give to you. If you're using funds from a 401k loan or withdrawal, you'll need documentation from your 401k administrator showing the transaction and any taxes or penalties. Here are some acceptable sources of funds that lenders generally don't have problems with: employment income, bonuses, tax refunds, insurance settlements, inheritance, gifts from relatives, sale of personal property, and legitimate investment gains. You can also use funds from retirement account withdrawals, though you'll need to account for any taxes or penalties. Some loan programs allow you to use vested retirement funds without actually withdrawing them. Now, let's talk about transactions that raise red flags and should be avoided during the look-back period. Large cash deposits are the biggest red flag. If you deposit more than a few $100s in cash, be prepared to explain where it came from. And "I've been saving cash under my mattress" isn't a great explanation. Rapid transfers between accounts can look suspicious, especially if you're moving money around to different banks or trying to consolidate funds right before applying for the mortgage. While this might be innocent, it creates a confusing paper trail that the lender has to untangle. Deposits from unknown sources will definitely get questioned. If your friend Steve pays you back for dinner with a check for $2,000, that's going to need an explanation. Overdrafts and bounced checks show poor money management skills and will concern lenders. If you're occasionally overdrawing your account, that suggests you're living paycheck to paycheck, which makes lenders nervous. Large or unusual purchases during the look-back period can be problematic too. If you normally spend $2,000 a month and suddenly spend $10,000 in 1 month, the lender will want to know why and how you could afford it. Here's how to avoid transactions that raise red flags. First, if possible, start managing your finances with the mortgage in mind at least 2 months before you plan to apply. Keep things simple and consistent. Avoid large cash deposits. If you must deposit cash, keep receipts and documentation of where it came from. Garage sale proceeds, cash gifts, or side gig payments should all be documented. If you need to move money between accounts, do it early in the process and be prepared to explain why. Moving money from a low-interest savings account to a high-interest savings account is understandable, but document the reason. If someone owes you money, try to get them to pay you back before the look-back period begins, or be prepared to document what the payment is for. Keep your spending patterns relatively consistent. This isn't the time to suddenly spend your entire emergency fund on home improvements for your current place. If you absolutely must make a large purchase or deposit during this period, document everything. Keep receipts, written explanations, and any supporting documentation. The key thing to remember is that lenders aren't trying to make your life difficult. They're trying to comply with federal regulations that are designed to prevent mortgage fraud. These regulations exist because some people have tried to get mortgages using borrowed money, fake documents, or other fraudulent schemes. Your lender would much rather approve your loan than deny it, but they have to follow the rules. The best thing you can do is be transparent, provide documentation for anything unusual, and avoid creating complications during the look-back period. If you do have transactions that might be questioned, don't panic. Most legitimate transactions can be explained with proper documentation. The lender just needs to understand what happened and verify that you haven't violated any regulations. The bottom line is this: during the look-back period, be boring with your money. Pay your bills, deposit your paychecks, and avoid anything that might require a long explanation. Save the exciting financial transactions for after you close on your house. Wrap up. Congratulations, you've just completed the pre-approval masterclass, which means you now know more about the mortgage application process than most people learn even when they're going through it. You understand how to choose a lender who's right for your situation, You know exactly what documents to gather and how the pre-approval process works, and you're prepared to navigate the mysterious 60-day look-back period without triggering any red flags. Here's what you need to do before we move on to Module 4. First, research at least 3 potential lenders and prepare your list of questions. Don't just go with the first lender you find or your current bank without shopping around. Second, start gathering your documents now. Even if you're not ready to apply yet, having everything organized will make the process much smoother when you're ready. Third, if you're within 60 days of planning to apply for pre-approval, start managing your finances with the look-back period in mind. Keep things simple, document anything unusual, and avoid major financial changes. Remember, getting pre-approved isn't just about proving you can get a loan, it's about positioning yourself as a serious buyer who can move quickly when you find the right house. In competitive markets, a strong pre-approval letter can be the difference between getting your offer accepted and losing out to someone else. In Module 4, we're going to shift gears and talk about finding your actual house. We'll cover choosing the right real estate agent, understanding how commissions work, developing a house hunting strategy, and making competitive offers. This is where all your preparation starts to pay off and you begin the exciting process of finding your new home. So I'll see you there.